What's going on, everybody? This is Economic News Insights, and today we're going to talk about how money really works. We're going to talk about the history of money. We're going to talk about how money is created. We're going to talk about the future of money, and we're going to also give you guys some fundamental terms about money. And the reason this is coming about is because I do see a lot of financial illiteracy out there. And this is by no fault of anyone else. So it's not to pick on anybody. It's just, I know that when I didn't understand economics and I didn't understand finance, I wanted to know what inflation was. I wanted to know what deflation was. I wanted to know what a recession was. I wanted to know what all these terms are. That's what we're going to talk about in this video. If you're excited, smash up the likes. Let's get into it. I'm not going to waste any time here. I will read some comments here as the time goes by. So drop some comments. First up, let's talk about the history of money. It went from barter to where we're at now, which is basically digital currency, right? So the barter system, that was in the prehistoric times around 3000 BCE. That was before money existed, right? So people used to basically exchange. They say beg, barter, that's like a phrase, right? Beg, barter, and exchange. But this is how it started back in the old days. People would barter goods and services. Then they moved into a commodity money. And that lasted for about 2,000 years until around 1000 BCE. And that would include things like salt, cattle, shells, grain. If you go around to like Africa or some of the other places, you'll notice they traded shells. That was the currency. They have that in Africa called cowrie shells. Asia, it was salt. Roman soldiers used to use salt as well. Now, you have something like the metal, money, and coinage. So you've seen when you go around to ancient places, you might find coins. I know when I went to Petra in Jordan, I saw coinage. So you could pick up little coins that are on the ground. They're still there. Believe it or not, I'm surprised that I was able to find some coins on the ground. But gold, silver, copper, you have Lydia, which is modern day Turkey, minted the first coins around 600 BCE. And coins had intrinsic value. They still have value today, although these little coins that I have right here, I don't really want to have them in my pocket because they always fall out. Then after you had the coins, you went to paper money. That started around 7th century until basically present, right? So China was the first to use the technology of paper currency during the Tang and Song dynasties that spread to Europe and the Middle Ages. By the 1700s, banks were issuing banknotes. So what would happen was miners in, say, Sierra Nevadas in San Francisco, they would go find gold and silver in the mountains, and then they would take it to Wells Fargo. They would deposit it, and they would get written a paper promissory note, and that had value because what were you going to do? Take a little piece of gold and sliver off, a little chunk to buy a cheeseburger? No. So it was easier to transact in paper banknotes. Okay. Then what ended up happening was they decided to go to the gold standard. That's where currencies were backed by a fixed amount of gold. And this brought along trust and stability in international trade because it was finally backed by something. So when people are always saying, "Oh, the dollar's not backed by something, Bitcoin's not backed by something," currency hasn't always been backed by something. That existed for about 200 years, but most of the time it's basically based off of the value that's given to it. So then it was abandoned during after World War II, essentially, and then they went towards the fiat currency. So in 1972, Richard Nixon put us on the fiat system. This is the modern money system that we've been using. It has no intrinsic value, and it's not backed by gold or anything else other than trust. It's pretty much backed by the government trust and supply controls. That's called monetary policy. So the government manages the monetary policy, and that was around like 1971, 1972. And then you have what we're entering into now, which is where we've kind of been, which is the digital money and banking. So you've got the rise of credit cards, online banking, Zelle, Venmo, Cash App, PayPal, mobile payments, Apple Pay. You guys have seen this. This is just digital currency. So you can see how things have been changing over time. That's what a fintech is, financial technology, the technology of how we do the medium of exchange. That's what money is. It's medium of exchange. How are you going to transact? And then they talk about cryptocurrency and decentralized money. So decentralized money is money that is not backed by a government, but it's basically just a network, okay? And it's peer-to-peer money. In this case, it would be based on the blockchain or some sort of blockchain or a hash graph that doesn't have a central authority. It's basically autonomous. It's like an AI money. And then it has other stable coins like Ethereum, CBDCs, stuff like that. So the possibility of the future of money, it's coming, and you can see that's not just something that people theorize. It's obviously coming because it always comes. We've just talked about 8 times the currency and the medium of exchange has evolved. Okay. So people who tell you, like, oh no, we're just going to stick with the fiat currency system. It's like, well, did you ever hear about what happened to the gold back system? Did you ever hear about the cowrie shells? Did you ever hear about paper money, coinage? And so it all goes hand in hand, right? And you can see how the evolution's taken place over time. Now, where does money come from? People probably want to know this, but we're going to talk about it. Some people know, some people don't. Central banks create base money. Institutions like the Federal Reserve, the European Central Bank, Monetary Authority of Singapore, for example, the IMF, the International Monetary Fund, and this is called base money. It includes coins, banknotes, digital reserves, and it's all held in commercial banks. Bank of America, JP Morgan, Chase. You can see it around the world, UOB, all these different banks. So commercial banks create most money. When you take a loan or a mortgage, that bank doesn't just lend you the existing money, it creates new money digitally. So you would think that, oh, well, they have to have that money on the balance sheet. That's why they pay me interest, because they use my money. No, it doesn't work like that. That system wouldn't really work. They are literally creating new money out of thin air every time you take out a loan, whether it be for a car or a mortgage. And this is called credit creation. So you get $100,000 mortgage, that money didn't come from someone else's account. It's created and added to the economy as a deposit. This is what fuels a word that we're going to talk about a little later called inflation. So this is possible in fractional reserve banking. Banks only keep a small fraction of deposits in reserve and loan out the rest, creating money in the process. Like I said, that's what creates the inflation, which depreciates the money that you're holding in your account. So that's why most people say saving money is an old, antiquated way of doing things. And where that comes from is the fiat currency system that came in 1971 and 1972, thereabouts, because before that, it was good to save your money. So that advice, save your money, that was a gold standard mentality. So as things change, you have to evolve your mentality and how you approach money. Thank you to everyone smashing up the likes as we continue to get this video out there. So the next thing we're going to talk about is government spending also creates money. So governments issue bonds to raise money. Central banks, they can buy these bonds. It's called quantitative easing, injecting more money into the economy. So most money is digital. It's not physical. So it's basically zeros on a spreadsheet. And then it's created by banks when they issue loans, and then destroyed when loans are paid off. The money is removed from circulation. Okay. So basically, you having an outstanding balance, you having a mortgage or a loan payment is debt, right? So the system fuels economic growth, but it also creates debt and inflation. If too much money is created, it devalues the currency, and that's inflation. It's too little. If too little is created, it can slow down the economic activity. That's why you need them to lower interest rates so more people are encouraged to take out loans, right? Very interesting, right? So how does inflation work? Inflation is the general rise in prices of goods and services over time. This means your money buys less than it did before, okay? So when someone says inflation is slowing, they don't mean that prices are going down. They just mean that the rate of inflation is slowing down. So we're not getting more expensive as fast as we were before. Recently, they had a meme that came out. The White House released a notice saying, for the first time in 4 years, inflation has reached its lowest rate. And everyone's like, well, nothing's gone down in the grocery store. No, that doesn't mean that things are going down. That just means that the pace at which it was rising in price has slowed. Example, if soda cost $1 last year, now it's $1.10. This year, that's 10% inflation. So that's what they mean by inflation. So why inflation happens? Too much money and not enough goods. That's the demand pool inflation. When people have more money to spend, demand goes up. If businesses can't produce fast enough, they raise the prices. That's just general supply and demand. Think of the stimulus checks plus limited products, prices go up. Rising production cost. When it costs more to make things, whether it be oil, whether it be materials, wages, companies raise prices to maintain profits. So inflation happens for multiple reasons. If oil is too expensive, what's going to happen is energy is too expensive, so they're going to have to raise the price. If wages have to go up, then that means they're going to have to make up for it on the back end. If they have to pay more in insurance, they have to pay more in taxes. Who takes that? Who eats that? The consumer. Also, currency devaluation. When a country prints too much money or loses trust in its currency, the value drops and imported goods cost more. So it's really important to take these things into consideration. Okay. So who controls inflation? Central banks, Federal Reserve, European Bank, J-Powell, for example, right? Try to keep inflation around 2% per year using tools like raising interest rates or slowing them, reducing money supply. So why it matters? Savers lose value over time. Borrowers benefit because they're repaying loans with cheaper money. For example, if you took out a $250,000 loan in, say, 2018, and inflation happened, that means that the impact on paying off that loan is less because it feels like less of a debt burden because there's more money in circulation, there's more inflation. So more than likely that $250,000 value on your house has turned into $400,000 because the price inflated, but also the impact on your bank account is going down. So it can help borrowers, right? High inflation can lead to economic instability if uncontrolled. So a little bit of inflation can benefit people who are owning property, but then when it goes down again, that's deflation, the opposite of inflation, when prices fall. But that sounds good in theory, although it's not always good because this can cause a recession. People delay spending, which slows the economy. People don't want to spend the money. They don't want to take out loans. That leads to a recession. Okay. So why prices keep rising? Because inflation is built into the system. Why do they have to have inflation? Most modern economies target inflation of about 2% per year. We talked about that. This is considered healthy because it encourages people to spend and invest instead of hoarding money. So people who tie up money, you'll see it where they tie up the money in the money market account. Warren Buffett is known for this. He'll tie up billions, trillions of dollars in the stock market, and none of it touches anyone's hands except for his company. I mean, well, I guess the investors, right? But, there's a lot of money tied up in Wall Street. Money printing and easy credit. When governments and central banks inject money into the economy, stimulus checks, lower interest rates, there's more money chasing the amount of goods. That causes a rise in demand, businesses, and increase the prices, okay? More money equals lower value per dollar equals higher prices. Rising production costs, we talked about that, raw materials, labor, fuel. Supply chain disruptions, like we saw in 2020, like the wars or natural disasters when a ship sinks. We saw that happen. Suez Canal had an issue. Fewer goods equal higher prices, especially for essentials. Remember toilet paper or chips? Remember, you couldn't even get enough toilet paper on the shelves because everyone was hoarding toilet paper. I don't know why Americans do that, because where I'm at now in Singapore, they just use bidets. Bidets are very common everywhere else in the world except for in the US, but they love their toilet paper. They need it. You guys need it. Americans need that toilet paper. They'll hoard it if they have to. Corporate prices, purchasing power. So big companies can raise prices even when costs don't go up because they have little competition or strong brands. Some call this greedification, controversial, but increasingly discussed. Okay. So corporate pricing power, they can actually drive up prices. This is why we have anti-monopoly laws. We have anti-monopoly laws. I mean, antitrust laws, as we call them. I was drawing a blank there. But then you have global events. This is something we're seeing right now. You have trade tensions, wars, global shortages, semiconductors, food, energy. All this stuff can really drive up prices. And then how the rich actually use their money. They buy assets, not liabilities. You go out, you might buy something that isn't appreciating in price. I don't know. You might buy a $500 shirt, a Gucci shirt. Well, the rich don't typically do that. They look at, like, when they're spending money, they're buying either real estate, stocks, businesses. They're buying things that make them money. And this is the difference between someone who's going broke versus someone who's actually getting richer with time, because they're putting their money to work for them. That's why we're talking about this in these videos, because we want to put you in position where you're growing your money and you're not just watching your money come in and come out. Okay. You want to grow your money. A great book that you guys can check out for that is Robert Kiyosaki's book, Rich Dad, Poor Dad, or The Poor Buy Stuff, the Middle Class Buy Liabilities, Their Assets, the Rich Buy Assets, right? Or thinking they're assets. They use leverage, debt strategically. So not all debt is bad. You know, if they're gonna, it's like kind of getting yourself in a position where you're gonna buy the house in 2018 because you see that the price is gonna go up, so you take out a loan. It's like a bet you're making on the market, and you know that the housing market is going to increase in value, and sure enough, it does. And it goes from 250,000 to 400,000. There's $150,000 in profit right there. After fees and everything and taxes, you know, you're looking at a little bit less, but they even know how to manipulate the tax system, right? They use low interest loans to buy appreciating assets. That's why some people like to have good high interest rates, because the higher your interest or credit score, because the higher your credit score, the better interest rates you can get. They think long term. So a lot of people, especially when they're new investors, they have this very short vision. They're like trying to get rich quick. They have like a 6-month window, and if things don't back out in 6 months, they'll sell it and move on. The rich, they have more patience because they're not living paycheck to paycheck. So yeah, it's easy to diss on people living paycheck to paycheck, but at the end of the day, when you got $1 million in the bank, it's easy to just play with $500,000 in the market, right? Well, when you're got $10,000 in the market or $10,000 in your bank, it's harder to play with money in the market, you know, because you're kind of barely scraping by, right? You got, you know, the $2,000 got to go to your rent or whatever it is. And then, but either way, they have retirement accounts, stocks, businesses over years or decades. So they're playing the long game. They also have compound interest favors. They use corporations and tax strategies to protect their assets. They use LLCs, which is kind of like limited liability company. But then they have trusts or corporations to protect assets, reduce taxes, deduct expenses legally. Now, they might make money work for them, or they do make money work for them, right? We talked about this a little earlier. Investments, rental income, dividends, royalties, business profits. Money flows to them even while they sleep. That's that passive income. You want to get your hands on some of that. What I'm saying is you want to figure out a way to get money coming into your bank account, kind of like the Saudis, every single day that their bank account goes like this, because everyone's always buying fuel, right? Petroleum. They invest in themselves too. The rich spend money on education. They get mentors, they get books, they get skills. You know, they're taking the whole thing very seriously. Whereas the average person, they're more interested in what's on the Netflix, what's over here, you know, where their next little game is being played. And then, you know, that's why they retire early. They see learning as an investment, not a cost. So they take the necessary steps to make investments in themselves. I would say this kind of information that I'm giving you, if you're watching this still until this point, that means that you've taken the time to actually educate yourself and get new insights and perspectives. And that's what's important. Smash up the likes, by the way. They focus on ownership, not labor. So you have this big idea, like some people are wage earners, some people are investors, but they strive to own things, companies, property, intellectual property, okay, trademarks. These are things that people do. So the poor, the way they do it, they earn and spend. Rich, earn and invest. Poor, work for money. Rich, money works for them. Poor, avoid risk. Rich, understand and manage risk. Poor, middle class, they save what's left. Rich, invest first, spend last. You get it? Okay, so dangers of the current monetary system as we know it. You have unlimited money printing, that's the inflation. We've got to be on the watch out for that, because central banks can print unlimited amounts of money. Sometimes they can get it wrong, and that devalues your savings and it causes hyperinflation. Debt-based economy. Most money is created through bank lending, which is the fractional reserve banking that we talked about. And then you have economies require constant borrowing to grow. That's kind of where the US is, right? Like it's like borrow, 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 spend, spend, spend. Doge was supposed to help fix that, right? So it creates a cycle of endless debt. I mean, what was it? It was 30 trillion. Now it's 35 trillion. Now I think it's up to $37 trillion in debt in the US. And it's not just debt that we owe to other people, we owe it to ourselves as well. So it's just debt in general, debts on the loans, all that stuff. But the big thing is that erosion of purchasing power. Okay. You know, you ask someone in the 1950s how much their rent was, they'll probably say it was $100. You ask someone in 2025 what their rent is, they'll probably say $2,000, $2,500. So it's gone up quite a bit. But that wealth inequality, asset managers, the wealthy benefit from the rising prices. Everyone else loses purchasing power. So when prices go up for rent, the poor people, they're spending more. But who's getting all that money? The people who own those assets, right? And that's how the rich get richer and the poor get poorer. And that's how you have to shift your mental mindset to where you're out of that and you're more into the think and grow rich mentality, right? And then there's the boom and bust cycles, the system's frequent financial crisis. Okay. We've seen this even recently, like the flash crash in April of 2025. We saw it, the flash crash in March of 2020. We've seen the big recession that happened in 2008. And then central banks come in, hey, we can fix the problem that we just created for everyone, you know, because the housing bubble collapsed or whatever, because they were doing predatory lending or whatever. And then they come in and they're like, we're going to print more money. And it kicked the problem down the road instead of really addressing the key problem. And then there's a lack of transparency and centralization, global instability, which we talked about. Now we're going to talk about the future of money and key trends. Digital only currencies will dominate, whether you like it or not. I know there's a lot of people who are going to say, oh, I'm not going to accept this because it's the mark of you know what, blah, blah, blah. I mean, we hear it all the time. I'm not saying you're wrong. I am not saying you're wrong. I'm just saying that this is the future of the world that we're living in now, and there's nothing you can do to stop it, period. There isn't. Because if it's meant to be, it will be, okay? All you can do is hope that you are on right here. You are doing the best you can, right? Future money will be 100% digital. That's where we're going. How long it takes us to get there, where we phase out everything else, I don't know, but it's going to be fast, it's going to be programmable, and it's going to be borderless. Apple Pay, WeChat Pay, Venmo, Zelle. If you don't already have digital banking, I suggest you get on it. The rise of central bank digital currencies, CBDCs, those are coming. Governments are launching official digital backed currencies by their central banks. China, CNY, EU, digital euro, US dollar, digital. Okay. They also talk about stable coins. Decentralized alternatives, cryptos will exist. Bitcoin, Ethereum, stable coins, non-governmental money. Decentralized finance, that's DeFi. We can get into all the crypto stuff later, but I'm just basically saying, like, you need to be paying attention to that. And it's not just me who's saying it. They're telling us. It's like, go read the books from the people who are creating the new world economy. They're telling you what's coming, and all you have to do is learn about what they're talking about. And like I said, you don't have to necessarily support it, but you have to be aware of it. And it's happening. So as fiat currencies lose purchasing power, people turn to gold, they turn to Bitcoin, they turn to real estate, and they turn to productive assets. I was having a conversation with someone yesterday. He was trying to tell me that he thinks Bitcoin's going to zero. He thinks gold is the only solution. But, you know, it doesn't, it just depends on who you're talking to. But like I told him, I think there's going to be a basket of multiple different diversification options: gold, Bitcoin, real estate, productive assets, stocks, money, you know, bonds, all that stuff. All those tools still will exist. And, you know, the more diverse you are, there you go. So programmable smart money, future money can be coded with conditions. And then you have cross-border payments. This will be instant and cheap. Right now, the current system uses Swift bank wires. Is outdated and it's expensive, very slow. Blockchain and fintech startups building systems where global money moves in seconds, not days, at zero cost. So increased focus on privacy versus control. In summary, get ready. Decentralized, digital, those are words you need to know. Borderless and instant, and then private. Okay. See, these are phrases that you need to know. Now I'm going to give you some more phrases. Okay. Supply and demand. The amount of good or services available is the supply. Okay. The demand is how much people want it, and where they meet sets the price. That's where prices go up and down. If there's a bunch of Tesla cars in the lot and no one's buying them, the Tesla prices are going down. If there's a bunch of houses that are built in the community and they're all for sale and no one's living in them, prices go down. If all of those houses in your community are full, that means that prices will go up because the demand is there. It's easy. That's supply and demand. Inflation, a rise in general price level of goods and services. It means your money buys less over time. We talked about inflation. So if it cost $1 to buy a bag of chips in 2020 and now it's $1.10 in 2025, that means it was a 10% rise in inflation. Okay. Deflation, a fall in prices over time. So where do we commonly see devaluation, deflation? We see that with the housing market right now. And then gross domestic product, or GDP. A lot of people need to understand this. This is a hard one, but try and get it in your mind if you can. The total value of goods and services produced in a country, kind of similar to what a market cap is. It measures a country's economic performance. So if you take everything produced by the United States, that's our GDP, gross domestic product. Unemployment rate, the percentage of the labor force actively looking for work but unemployed. Okay, that's the unemployment rate, a key measure for economic health. They kind of fudge that number, I've noticed a bit, because they say like people who stop looking for jobs are no longer considered unemployed after a certain amount of time, but they're still unemployed. So you get what I'm saying? So it's kind of how they kind of finagle that one. Interest rates, that's the cost of borrowing money or the reward of saving it, set by central banks to control inflation and spending. So basically, if you wanted to take out a loan for a house, right now it's around 7%. When I had a loan in 2018, I got it down to as low as 3%. So 3% on a $1,500 monthly payment is a lot less than 7% on a monthly payment. That's the total loan. Okay. So interest rates do play a factor. Pay attention to that conversation. Recession, a period of economic decline, usually defined as 2 consecutive quarters of negative GDP. So we just talked about GDP, but you need 2 quarters. There's 4 quarters in a year: Q1, Q2, Q3, Q4. Right now we are in Q2. Q2 ends at the end of June and starts Q3 July 1st. Okay, 3-month quarters. So in the first half of 2025, we're close to a recession. We'll see. We'll see what ends up happening. Because of the trade war. Fiscal policy, government decisions on taxes and spending to influence the economy. That's fiscal. Fiscal policy is basically government policy. That's what the word fiscal means, for money. Stimulus checks, infrastructure, investment, government handouts, welfare, blah, blah, blah. You could all call that fiscal policy. Then there's monetary policy. That's central bank actions to control the money supply and interest rates used to manage inflation, employment, and growth. But that's done by central banks, not by the gov. Then you have the budget deficit versus surplus. So deficit, government spends more than it earns. So if you have a deficit, that means the government's spending too much money. It's not bringing in enough money and it's spending more than it's earning. Surplus, government earns more than it spends. You want to be somewhere in the middle, balance. Everything is balance. I'm telling you, everything, your diet, everything in life, the way you manage your money, the way you manage your relationship, good, bad, evil, it's like you want everything to be kind of balanced. Okay. Got to take the good with the bad. All right. Because nothing is perfect. And that's balance, right? It's like too much soda is bad, but a little bit of soda can be fun, right? Too much chocolate is bad, but a little bit of chocolate can be good. A little bit of meat is okay, but too much meat, maybe not so good. This is the idea. Balance, budget deficit, surplus, right? Opportunity cost, the value of what you give up when you choose one thing over another, key concept in decision making. And then you have the market economy, an economy where prices are determined by supply and demand, not the government. That means that the free market determines the price, not government controls trying to manipulate and, basically set the money based on how they want to do it. Thank you to everyone who smashed up the likes. Thank you to everyone who watched. This was a basically economics 101 beginner's guide to economics. If you guys want more videos like this, we can do it. See you guys on the next one from this channel, Economic News Insights.